Hello, hello. Good morning, good afternoon, good late evening, wherever you're coming in from. I'm here in New York, so good morning to everybody. We are thrilled to be doing this again. So, welcome to Sightline's 2025 Climate Tech Investment Trends Report. This is a review of our flagship report, and it's kind of a fun one for us because this is our fifth year writing these. So I don't know if you even remember what you were like back in 2021, but we were waxing poetic about what happened in 2020, which is totally nuts to think about. So thank you for being with us. So we've got hundreds of folks joining for this report review, and we've had many hundreds already downloading it and engaging with us through all sorts of different channels. So this is a real treat, and we get to bring the gang back together. So, um, we're mostly focused on the report review, but you're also getting something special this go around because tomorrow, content never sleeps, right? So tomorrow we're publishing our prediction bets report, which nearly 500 of you also weighed in on. So I'm sure there's some folks joining for this webinar who also participated in our survey. Thank you so much for doing that. Not to tease too much of the results from that, but there was a surprising amount of homogeneity, I think, through those responses, which kind of, I don't know, maybe means we have some sense of where the market's going because, gosh, it's been pretty darn weird, right, historically. So look out for that. And we also stress tested the group responses with a whole set of insiders who had some hilarious and sometimes clever things to say. You're getting a preview here. Alrighty, so it's the four of us, and I'm going to walk you through the agenda. We've got a jam-packed hour coming up where Kim will be leading the way right off of the bat with what you're really all here for, right? So a tight recap of our investment trends report. Let's see how quickly that she can do this. I think she's got 20 odd jam-packed slides to get through, but she's a real pro at this point. So excited to see Kim shine. Then Julia will be taking us through an interactive poll. So get your fingers ready. This is your chance to help us all predict the future. So you know the drill. We'll be popping stuff up in the Zoom Q&A pop up, and would love for you to engage. This is all the better, the more of you that play with us. Think of it as maybe like Kalshi without actually betting. Okay, once you're hyped up, then it's our turn to start sweating with section 3. Mark, Kim, Julia, myself, we're going to take our gloves off and start boxing with our bets and maybe against one another. It should be nice and juicy. And then we're transitioning again to a quick fire round. So we couldn't not do this. This is the like what's hot, what's not, what's in, what's out, what are we going to be talking about a year from now. And then our last section is another time for you guys to really engage. So this could go any way that you guys want it to. This has historically been a really robust part of the conversation. So maybe it's called Q&A. That sounds kind of boring, but it's actually pretty juicy. So please engage with us throughout the course of this conversation. We're actively looking at all of those questions. This is your chance. You've got all of us live right here, and then we'll be taking those questions at the end to wrap everything up. Okay, no further ado. We have an hour. We have a massive amount of content to get through, and you've got all four of us. I'm Sophie. Kim's coming up on stage, needs no further ado, co-founder and CEO of Sightline. Genius Julia, trying to make her blush in the back channel here, as our research director. And then, of course, we've got Mark, who always brings fantastic insight and predictions to the table. All right, Kim, your turn. You ready to hit your slides?
All right, let's go. Thanks so much, Sophie. You're a real pro. All right, let's get into some of the 2025 recap. It feels like it's just the start of the year, but we somehow feel already halfway. So we'll keep this relatively tight so we can get more into how we're feeling and thinking about 2026. When we put out this report at the start of the year, it was pretty surprising results. I think since 2022, since we've been tracking this space in 2022, there's been a steady decline, as you can see very clearly in this chart. And what was actually surprising is for the first time since that decline, climate tech funding rose 8% in 2025. And you might think, wait a second, the US and the Western world in general, the world in general, has had a bit of a challenging 2025 when it comes to climate policy headwinds, climate writ large, how is it possible that investment rose 8%? So we're going to get a little bit into those trends behind the scenes of why investment actually increased 8% this last year. But before we do that, before we talk about the trends, we also want to talk a bit about where that investment has gone and where investment could be going forward. So where has all of that investment gone? When we look at this from a geographical standpoint, it's clear that despite a lot of the policy headwinds in the US is still where most of that investment has gone. H2 of 2025 really supercharged the US investment almost tripled, and Europe actually decreased. US is now double the amount of Europe's funding. This is relatively surprising, you might think, but we'll double click into some of those trends in investment under why the US has increased. The other view we want to look at as well is where might investment go in the future? And so it's always helpful to look at investment flows, but what we also do at Sightline is look at new funds that are getting raised in the energy and climate space. So a lot of that investment has been going into the US over the last couple of years, but when we actually tally up the amount of new funds and the dollar value of new funds that are getting raised, you can that Europe actually makes up the majority, almost 50% in terms of count, more than 50% in terms of value, in terms of number of funds that we've counted in 2025. So, from a forward looking perspective, we can see that Europe is where a lot of the funds that are getting raised are headquartered, which also is a signal that LPs, institutional investors, pension funds, sovereign funds, a lot of the limited partners that are investing into these funds tend to lean more Europe heavy. There's still appetite in Europe for climate and energy as themes. And increasingly, we might see more investment going into Europe because of that. I think a cool kind of surprise and highlight as well on the right hand side here is APAC. That APAC didn't make up a ton in terms of dollar value, but made up an increasing amount in terms of count. And we're seeing a lot more activity in climate tech and energy innovation writ large in the APAC and MENA regions. A lot of those are smaller funds, earlier stage, as innovation activity starts to pick up in those regions as well. So our prediction here is look out for Europe and APAC, especially given the flow of LP dollars that are going into funds. So let's see what that shakes out to in 2026. All right. Those are the top line. Let's dig into the trends, right? I think the interesting part of these reports is always the why, not just the what. So there are a couple of trends we want to talk about here. I'll run through them real fast, give you a little preview, and then we'll get into the fun data cuts. So first trend here, AI is the new demand driver. Not much of a surprise to us all here. Second is security and resilience gets a premium. Capital concentrates as the market matures. Liquidity matters and the start of the adaptation era. The two big themes I want to pull out here, the two big things for why investment increased last year was really this broader theme of energy and AI driving up a lot of investment, paired with the fact that climate tech as a whole is going through its maturation phase. Can be painful at times. There were definitely some bankruptcies, there were definitely some fallout, some acquisitions, but also a lot of mega rounds and a lot of superstars emerging in the ecosystem. So let's double click on AI first. AI is the new demand driver. I've never seen this emoji before. This is cool. The upgraded emoji. AI is the new demand driver. So what exactly happened this last year in terms of investment? We saw that energy and built environment in particular led a lot of these resurgence. So transport stayed relatively flat. Food and land use decreased almost 30%. Climate management also stayed relatively flat. Carbon decreased about 24%, whereas energy, built environment, both of them were up more than 20%. This is particularly because, as we all know, we've beat this drum again and again, AI is really changing the shape of power demand and therefore really changing the shape of investment that's been going into this space. A lot of the trends we've been seeing across investment has gone into areas like clean from power, low carbon data centers, all of which fall under these two areas of energy and built environment. So if we click into the next slide here, what we wanted to do is actually take out data centers, take out nuclear, to look at this in a more normalized view, right? Because of that inconsistency. And I think this is probably one of my favorite charts from the trends, from the reports, which is to really just understand what the investment would have looked like without data centers and nuclear. And in fact, 2025 would have been a down year. So you can see here in the gray bar, this is investment X data centers, X nuclear. And over time, it has been decreasing, but data centers and nuclear made up such a large portion, almost 27% of investment in 2025. And so that is the key theme here of 2025 and the recap that we called it, trading out emissions for electrons, that the demand lever for climate tech over the last couple of years has been one of emissions, has been one of decarbonization, one of net zero. 2025 was when we saw that demand lever really switch to AI, to power demand as the core driver here. Now let's double click into the second theme, security and resilience get a premium. We've defined security a couple of different ways here. There's security in the sense of energy security, right? Securing energy supply. There's also security in the sense of reliability, of having firm power to power data centers. So if you look at the top 10 climate deals that we tracked in 2025, there were four in particular that popped out that were under this theme of energy security. They were at the top here, China Fusion Power, a massive, massive deal for fusion in China, Commonwealth Fusion Systems, X Energy, and TerraPower, all nuclear deals, all almost $1 billion. And you can see here that nuclear, in a way, is going to be that last frontier, that last race for leading the pack when it comes to power. China, for the most part, has already won that race in solar, wind, batteries, and renewables. We think that nuclear is kind of the last frontier in terms of really building up that supply chain, really building up that security. And so we'll see how that nuclear race plays out over the next couple of years. The next two in this mega deal is really touched on system resilience. So base power, doing residential storage, VPPs in Texas, eel power, doing something similar in Europe. There are a lot of core themes this year around energy storage, on system resilience, both because of power demand trends needing more resilience in the overall grid for increase in power, but also because of increasing wildfire risks, increasing renewables coming onto the grid, really needing that stabilization and more distributed flexibility. So mega deals really clustering around energy security and system resilience. Next, we're going to double click into capital concentrates as the market matures. The way to summarize this, I think, is climate tech is in its maturation year, right? It's almost like the last couple of years, climate tech was growing up. It was, a teenager. Now it's really in its 20s or so where it's getting into the maturation phase. And so this was one of, I think, my biggest takeaways and surprises of the report, that for the first time in a couple of years, the early stage is in decline and growth stage is in the increase. So early stage, seed series A, both declined 20%, 7% respectively, but then growth had this massive jump of 78%. This is the first year ever in a couple of years where we've seen that huge jump in growth and that decline in the early stage. And this was in particular also showing up in the deals, right? Even the deal count for early stage fell, whereas the deal count for growth stage increased. So it wasn't just the funding amounts, it was also the deal count. And if we double click into that growth part of the bar, we can see here that just a few companies made up the majority of funding in all these key sectors. So all these key areas of clean from power, security, resilience, even carbon markets, there were a couple of core emerging winners that made up the majority of those capital stacks. So if you look at that teal bar, that is quite literally how much investment in that sector came from the logos that we have here. This is a pretty stark chart to showcase the fact that it's a couple of winners. It's kind of feast or famine, if you will, when it comes to the climate and energy technology sectors right now. So data centers, N-scale Crusoe, driving over 50% of that investment. And the way we look at data centers is we particularly look at low carbon data centers. So we're not looking at all data center deals, we're looking at low carbon ones. And then fusion, nuclear, grid, geothermal carbon markets also had a handful of winners that really drove a lot of investment in those sectors. So it's really a feast or famine dynamic that we're seeing in the market right now and probably will continue to see in the market. All right, double clicking into liquidity. And obviously, liquidity matters, right? Investors invest into this space because they're looking to make returns, looking to get their money back. And now that we're in this maturation phase, we're starting to see some of that liquidity hit. 2024, 2025, we saw exits start to rise again. 80 to 90% of this, as you can see, have been acquisitions. So lots of acquisitions. Many of them are tuck-in acquisitions. They don't have valuations, are undisclosed. It's a lot of larger companies who have gone through that maturation cycle that are doing quite well, buying up smaller companies. And that SPAC route we see here in pink is also continuing to shrink. And so if we double click into the acquisition side, we can see here that a lot of those acquisitions really came from consolidations in specific sectors that have been going through that maturation. So renewables development, especially as ITC and PTC are starting to get retired towards the end of this year because of the new OBBB bill. A lot of consolidation as developers are consolidating to short balance sheets. On the emissions and sustainability reporting side as well, we're starting to see a lot of companies get scooped up there. And then lots of larger corporates starting to buy up grid technology plays. So the Hitachis, the ABB of the world all made grid tech plays this year as well. And then last but not least, we think this is the start of the adaptation era. And so if you look at that climate management bar, historically, that's been one very focused on emissions and sustainability tracking, carbon accounting, ESG reporting, those sorts of plays. That dropped 74% this year, which is wild. Instead, that overall climate management sector was traded for Earth observation and adaptation. Earth observation because now AI unlocks a lot of this ability to look at geospatial, look at large swaths of Earth data. Climate adaptation, because inevitably we are entering a world that's going to get a lot hotter, that's going to be experiencing a lot more extreme weather. So we saw a lot of different plays for wildfire management, for insurance. And then we even saw our first geoengineering deal, our first venture-backed geoengineering deal. Stardust Solutions, which is a solar radiation company, raised 60 million from Lower Carbon and other investors. So look out for more in this adaptation and geoengineering theme. All right, we talked through a couple of trends. Think this is a really nice way to turn it over to Julia, our research director, to talk a bit about how this could stack into what could happen in 2026 and beyond. Julia, over to you.
Thanks very much, Kim. Well, we hope that you've all been paying pretty close attention because for some of the questions that we've given you some hints from the historical data, but we really want to know what you are thinking about all of these trends. So we're going to bring up some polls. You'll see a little box pop up in Zoom. So if you've got us minimized, bring us back. You need to vote. We're going to go through question by question, and then I'll show you, you'll be able to see the results on screen, and then I'll show you what the Oracle was thinking. So what the hive mind in climate was thinking on all of these questions. So the first question is about climate tech venture funding, and I'm going to launch the poll, so you should be seeing it on your screen, and you can choose one of these options. So do you think in 2026, this year, is climate tech venture funding going to increase significantly, increase slightly, stay flat, decrease slightly, or decrease significantly? We're really going to weed out the optimists and the pessimists here. And it looks like everybody is kind of playing it a little bit safe. You're feeling optimistic from everything Kim was talking about. Maybe you know of a bunch of adaptation plays that you're positive are going to get a ton of investment. Cool. Okay, we're starting to flatten out here. So I'm going to end the poll, but basically we've got more than 50% of you saying increase slightly, and then a little less, around 20% now saying stay flat or decrease slightly. So overall, some cautious optimists. So I can tell you that what the prediction market said was pretty much agreeing with you guys, although it was a much bigger split between increasing slightly and staying flat. So everyone feeling a little bit good about 2026, but not wanting to be caught out by any of those big drops or rises. So the second question really taps into all of the trends that Kim was talking about around AI. So here we're thinking about which AI demand scenario is going to play out. So if I launch that poll, is it going to be a bubble pop? So all of a sudden, are you going to see like this AI demand disappear? It was all a phantom. It's gone now. Slowing growth, so maybe still growing, but not as fast as we would have thought of, a plateau, or is it going to absolutely explode? As Kim was talking about, this is really what underpins a ton of the climate tech investment, because it's not just the energy for these data centers, and things like nuclear will come into play in the 2030s, but things like grid tech or flexibility options, storage options, those are really things that can make a big difference right now. We've been tracking data center projects pretty closely, and we can see that there's a ton of them coming online this year and next year, and how those are all going to get powered is a big question. Okay, you guys are basically saying slowing growth, but it's a lot more even than that last question. So slowing growth, and then the second most popular is explosive growth. So clearly a lot of you very interested in growth in AI demand. Well, the Oracle, the prediction market said, yeah, probably slowing growth. So they pretty much agreed with you. And actually the percentages are pretty close to what you guys are saying. So nice job. We think that there is going to be a lot of strain on the power side of things. There's a lot of speculative projects out there. There's a lot of people who think that AI is the new way to get investment in their town, to repurpose coal plants, to bring back jobs and industry, especially in places that got hit hard by deindustrialization. We're waiting to see if that will happen. There's going to be a lot of strain on the grid. It's not clear how all these things are going to get powered, and everybody still wants to plug into that grid infrastructure. We're not seeing this huge wave of on-site power that's being talked about further down the road. Okay, one last poll for you all, just to make sure you get to have your say. And this one is about geography. So which region will see the fastest climate tech investment growth? So will it be China? Will it be Europe, India, LATAM, Latin America, MENA, that's the Middle East and North Africa, Southeast Asia, or the US is right down there at the bottom. You've probably got to scroll if you want to vote for the US. Some super interesting results coming through here. China looking very popular. China has been skewing a bunch of our expectations for what is a Series A and what is a Series B in recent times. They're really kind of redefining how much investment they're willing to put into a pretty early stage company. So nearly half of you are saying China, and then we have some optimists around Europe and around Southeast Asia. So you can see that what our readers thought was actually they were a lot more optimistic about Europe. They think that all of that funding that is being set up in Europe is going to flow into European countries. So finally kind of breaking the stranglehold that the US has had on innovation, startups, the capital stack. So the prediction markets are saying Europe. You guys are very optimistic about China. That was the second choice in the Oracle. So I think everybody pretty aligned. You've all clearly been reading the same stuff. I guess everybody is going on trips to China and Europe this year. Nice. Well, now we want to get into our bets for 2026. So I need everybody to come back and join me, and you're going to see all of us discussing what we think is going to happen in 2026.
All right. That was super interesting on that last one, the China versus Europe one. That was the only one that didn't quite match up. But yeah, will be interesting to see how that plays out. All right. I guess I can kick off with my first bet. So, for those on the call here, we kind of gave ourselves a homework assignment where we said everyone would come prepared for one hot take, one bet for this year. And I cheated a little bit because I have one bet, but it kind of breaks out into three mini bets. But I'll go fast, I promise, and then you guys can debate me. So my bet, I think, is 2026 is going to be the year where we start moving from training infra to inference. So I think those of you who are in the venture Silicon Valley audience, there's been a lot of talk about moving from the infrastructure side of the AI equation to the application side of the AI equation. And I think that's going to start to play out across all layers of infrastructure. In our world, in climate and energy, we think a lot about infrastructure from this perspective of power infrastructure. But I also think this is going to start playing out from the perspective of AI infrastructure, where large language models are going to get consolidated. They're going to become a lot more mature. We're seeing a handful of players like Gemini, Anthropic, obviously OpenAI emerge. And I think that era of just a lot of data centers getting built for training is going to start to slow down, which therefore means a lot of those mega data center clusters, the 1 to 6 gigawatt plus data center clusters, you're not going to see as many of those big announcements anymore. And we're going to start moving back towards inference. We're going to have a lot of data centers that are closer to urban regions where people are using AI than big data centers in the middle of nowhere. So that then to me means three things. One is we're going to start seeing potentially some stranded capacity, right? We have all these big mega data center clusters launching these gigawatt sized data centers. What's going to happen to all that stranded capacity, right? The second thing that I think could happen is when we start moving back to inference, you're going to see a lot more distributed, smaller scale data centers. I think that will start to mean power quality over quantity matters. So reliability, five nines will matter a lot more. Response time, ramp time will matter a lot more. And overall quality of these electrons, not just quantity, will matter a lot more. And then I think the final thing is what I've been calling AI second act. I think towards the end of last year, it felt like we were entering that trough of disillusionment in a way of AI, like all these chatbots and agents. Everyone had a chatbot and an agent, and it was kind of like this stuff is useless. But now you're seeing the emergence of a lot more AI native ecosystems, data stacks, where it makes it a lot easier to do things like retrieval augmented generation. You get better context, you have better, more useful AI. And so I think this year we will actually see useful AI in the world, things that aren't just customer service and chatbots, but things that could actually help reduce a lot of the soft costs in the power value chain, from permitting, regulation, field services, operations, a lot of those real world applications I think we can start to see this year. So that's kind of my 3-in-1 bet. But yeah, what do you guys think? Debates, anything you agree with, disagree with?
I love the three part. There's so much in there.
Yeah.
Um, so I'll give you an equally complicated answer from me in that I'll agree with some parts and then hedge on others, Kim.
Good.
I totally agree with the move of like a focus on inference because I think you can see how rapidly people are uptaking AI, and that means that there's going to be a lot more demand for just using it. I think people are a
Yeah.
lot more confident now that they can see those sources. I wonder, though, what that actually means for infrastructure, because in general, most of the really serious AI players are still spreading where they're putting their data centers. And if you think about like the time spent on like latency of the issue of getting like an answer from a data center in California over to New York, it's probably a few seconds, whereas the time that a model spends thinking is more like 10 or 20 if it's a really complicated question. So I wonder if these players look at this and are like, you know what? I went to all this trouble of building this massive data center. I'm just going to use it for inference, and I'm going to lobby the telecoms people heavily to start massively, massively building out rapid connections. So totally agree with the use case, but I wonder if they do everything they can to try and preserve those assets.
I like it.
I'm going to throw in a couple. Maybe it's a 5-1, maybe it's tack on, maybe it's 6-1, tacking on Julia's. But I think it's kind of what you're saying. I think there's going to be at least one kind of epic giga center fail, right? That we're just going to see one big catastrophic sort of, I don't know if it's a Cylindra style, level of PR, but it's going to be something where like, oh, this big style of data center just doesn't work. Um, the reasons, being that it's, community opposition, that there is this shift. I agree with you that a shift to inference, and the less of a need for the large giant data centers. There's also risk from new GPUs coming in, more efficient, less need for larger size, et cetera, et cetera, et cetera. And I think the other thing that's kind of one. Two is that I really do think this right where late last year Chris Wright wrote that letter to DOE, directed them to look into what this advanced notice of proposed
A
rulemaking, excuse
noper.
me, that will an OPER, yeah, that will enable large loads to connect directly to the transmission grid, right? And this would really change everything. And it's a 20 megawatt threshold. So anything above 20 megawatts could, in theory, connect to the transmission grid. This could change who the generators are and how they operate, where the data centers are, how big they are, everything like that. Side note, that it's tried and true in several other markets, including where we are here in the UK today. But it just hasn't been done in the US. But I think it'll go through because the administration really likes to push things through. And I just think it'll go.
Will that be good, or is that good or bad for
Depends who you
some of
are.
these
I
like
think it'll
big,
hit
yeah.
tons of utility and PUC opposition, tons. But as I said, I think this administration just likes to push things through, and I think this will be muscled through. But yeah,
And I'm
yeah,
assuming that's good for the hyperscalers. That's good for the data center developers.
you would assume so. Yeah, yes.
Yeah, it's pretty similar to what you're starting to see in Europe, where they'll see things as like strategic assets. And you could
Yeah.
argue that anything that large is a strategic asset, and where that's getting to like skip the queue. So that's already happening in the UK. I think this is like the US version of it.
Yeah.
Hmm. Interesting. So Kim's going for like more distributed, modular, localized, and you're playing on that a little bit, Mark, but with large loads being more responsive.
Yeah, well, I don't know about responsive, but I think super duper large loads are maybe not going to be a thing. I think predictions are great because you can be wrong. I'm happy to be wrong about this. But
We are recording, Mark. Remember, we
I
record.
know, I know. That's totally fine. Totally fine. But yeah, I don't know about responsive, but I think there's going to be more of them.
Yeah.
Responsive
Just
wasn't right. I meant
yeah.
like reactive, like
Okay, yes.
faster time to speed. Yeah, yeah. Well, I mean, who loses in this
Totally.
scenario? I guess hypothetically, utilities having chokehold control, right?
Mhm.
I know behind the scenes we talk a lot about the shift of like who has power in these scenarios, and so it's much more getting closer and closer to the individual consumer, I suppose. But that's really not
Mhm.
how much of the Trump 2 administration has been um, playing other strategies. So interesting.
Yeah.
Um,
Mark, what's your bet for the year that people are
Okay,
thinking about?
it's kind of niche and it pulls us out of this data center world just for a second. So let's change
Thank
hats just for a
thank
second and let's
God.
change continents, right?
No more
Um,
data center talk for now.
just for a minute, just for a minute.
Yeah.
Okay, so I've been watching carbon capture since 2007. I know, for a long time, for my sins, all that. And every year has been the year that it could break out, but I've always been, every single time, been the skeptic in the room. Um, there's never been a strong demand signal for it. But I think this year could be the year where there could be an actual demand signal in Europe. So
hmm.
the EU ETS, the carbon trading scheme in the EU, is set for a revision or a review during this year. And one part of that is that there's this introduction of these things called NETs. It's negative emission technology, certificates. This means DAC. It means BECCS, like bioenergy CCS, so biomass fired CCS, where they could store the CO2 and claim negative credits that they could sell on the market. So what this means is that things like BECS and DAC could become not just a compliance mechanism, like under the UTS, but a revenue generating mechanism under the UTS. That's thing one. Thing two is that if, well, not if, that the EU has this target of capacity of 50 million tons of CO2 captured and stored per year by 2030. Now, last time I checked, that's in 4 years. And they're nowhere near close to that right now. And they have this new, call it hub for CO2 collection storage called Northern Lights that's undersubscribed, right? And so if you could put a system into place where there's an incentive to actually go do some CO2 capture and storage, then you could potentially catalyze some growth in a sector. So my bet is that this thing is going to go through. It's in review this year. I think it's going to pass and become part of the ETS and could catalyze some CCS. Well, it could catalyze some BECS and potentially some DAC.
And in this case, why is the idea that because you can kind of revenue stack these incentives and the fact that you're actually generating revenue from these assets, it's power generation, that this is a better play on CCS than just, let's say, like putting CCS on some gas, because obviously that's been a big part of the conversation as well.
Yeah, well, I mean, the ETS has always been, it has to be, the price has to be high enough to where it hurts you more to just to pay the penalty rather than to do CCS, or unless I got that backwards. But here, if you can actually make money on it, you can improve your economics even further and not just comply.
Yeah, it's a super interesting advantage of Vex. And I think I've been a fan of Vex for a while. It's gotten a really bad rap because of Drax. But I think that was really the wrong application of it, because that was a coal plant that they tried to switch over to biomass, and it's giant. And they didn't really have the transport and storage lined up. Now they do, because the UK is committed to building the pipelines and the storage systems. But BECS in other regions is really about trying to like tailor the feedstock and fuel that you have to the size of your plant to an asset that has access to storage. And I think that's, if you size the plant correctly, then you can get access to super cheap feedback. And Scandinavia has pretty big lumber industries. You've got paper and pulp industries that can feed into this too if they have access. So it's kind of a perfect storm. And I know, Mark, we've been talking about that Stockholm Exergy project, which is actually waste to energy. So I think I agree with you. I don't see why this wouldn't pass. I think it's a good idea.
Well,
They should do it.
EU bureaucracy, all that, but
Okay,
yeah.
so maybe not pass this year, maybe pass next year once everybody agrees.
That's the bet I'm making, is that I think this, there's only the 2026 review is a thing, like on the EU ETS calendar. And if it doesn't happen this year, it won't happen for a while. And if they want to hit this 2030 target, it's got to be this year. And so this seems like, to me, it's like the easy one to tick off. And, while there's a whole rewrite or rethink of the EU ETS, this is like one line item where they can say, yeah, okay, that makes sense. We can try to get some revenue out of this tech.
My devil's advocate here, though, and maybe we're not explicitly disagreeing, but my devil's advocate here is it just seems kind of like a capped opportunity for CCS. I do think from a, economic standpoint, this is probably one of those scenarios where it makes sense, but it's limited by feedstock. You're competing for feedstock with things like fuels as well. So it might happen, but it sounds like it's going to be a relatively capped, limited amount of plants. But hey, we're tracking BECS projects. So maybe in the future we'll do some webinar on how BECS projects are changing over time, and we can see how it grows or stays the same.
Never said it would be huge. Only said it would be more than zero.
Yeah, the cellulosic ethanol people are coming for their feedstock.
All right. This is getting nerdy. I love it. And thank you everybody for asking questions of like what the hell is BECS in the Q&A. So we got you. I'm gonna jump in and pivot us to If Mark is like incredibly nerdy from his since 2007 view on the carbon markets, thanks, Mark. I'm going to pull us up of like real time, what's an early stage venture capitalist who's trying to make money in this space thinking about, aka what I go to bed and wake up thinking about. And so this is like painfully high level, if you will, but I think, and we've said this before, so it's more of a continuation of that trend of consolidation. So let me break that out a little bit further, right? Like, I think we're in an era, and this pains me to be totally honest, of where relationships trump tech superiority or edge. So it's kind of like access matters more than ever. And I think
Mm.
execution trumps strategy. So it's just speed. Um, and I think we've seen that playing out, right? And I think the way that we know that that is like a proof point or not comes in the form of consolidation. So maybe I can kind of talk you through that a little bit further. Sentiment comes from zero interest rate phenomenon period, right? When we're all when climate tech was kind of having its comeback time, 2020 through whenever you want to call it, 2023-ish. Zero interest rate was a sprouting of 1,000 seeds. Just look at our data, all the companies that got started. Um, we're not in that era anymore. I think we're in a period where there are resources, right? There's capital, there's customers, there's some interesting policy pockets, but those resources go to a few fast growers, if I'm trying to maintain this seed analogy, right? Maybe those are existing players, maybe those are some new seeds, but they're just getting all the resources right away and they're quickly, oh my gosh, I need to stop this metaphor, but they're quickly shading out the tiny seeds around them. Um, uh, Relationships, speed, ability to pivot,
Yeah.
I think matters way more in a period of
Mm.
volatility, more than the cleverest business model or the best technology or unit economics. I think it's just narrative kind of over
Mm.
everything. It's like flood the zone meets startups. I don't think that's an efficient market, but I think that's what's happening. Second point, you know, uh, the more aligned that you can be in an inefficient market to the essential pivot points or unlock points, which in this case seems to be regulatory favoritism, alignment with administrations, alignment with huge capital agglomerators. It's just a bigger get bigger. And so it's like new trade routes of capital flows if you want to get fancy with it, right? Like, do you care more now about aligning with like Sam Altman, or do you care more about aligning with like
Mm.
a government? I think there's just different capital flows or
Mm.
different capital trade routes. And I also think that, just to say it out loud, all that matters is growth, right? It's
Yeah.
like Trump's whole policy is just like make number go up. So like, just growth rate in venture. It's all about growth rate. We're competing. Climate founders are competing with, pure play AI, revenue ramps, which are really difficult. And I think we're so far gone from the era of like clever efficiency plays or even, decarb. I think it's just growth rate, growth rate. So anyway, I think all of that aggregates around consolidation. The big get bigger, more dollars concentrate into a few sweethearts. Whether those are the best technologies or the most robust business models, sometimes doesn't even really matter. And so we're seeing that already play out with the large generalist funds participating in the biggest rounds that Kim just had a really nice
Yeah.
slide on, your Base, Crusoe, Nscale, Radiant, etc. And we're starting to see this inside the subset of climate with like actual coalitions, which are anointing supposed winners, right? Like that's kind of what All Aboard Coalition and like the dozen odd or so funds that are participating in that are explicitly up to,
Yeah.
for different kind of more impacty altruistic perhaps reasons. But and then last consolidation point, because I've been waxing poetic here, but consolidation has another angle to it. We've been talking about the fast growers get bigger.
Mm.
There's also consolidation of the smaller players mo
Mm.
merging together, and those are fine, often not super exciting outcomes, but we're certainly going to see that a ton this year. We're
Yeah.
already seeing it in the back channel.
Hmm.
So merging of small to small, or small to slightly bigger, or small to slightly better capitalized, or small to just more aggressive, and they still got the grit to keep going as a company. And especially amongst those that have a similar business model and or who are playing in the same market, but maybe the market is just much smaller than we had thought or hoped, aka voluntary carbon markets, right? So
Hmm.
roll-ups, consolidation, partnerships, and a long tail of bankruptcy from absorptions. Um,
Yeah. I think the flexibility and pivoting point you made is also really interesting because, from talking to a lot of companies last year, feels like everyone was, how do we take advantage of this whole energy data center AI thing? People who were once selling to, let's say, EV charging have now pivoted to, okay, let's sell to data centers. And you kind of saw that again and again and again. And I think there's this model of, you know, follow where the growth is. And a lot of companies starting to look at, that part of the market and even pivot their tag, pivot their business model to getting after the opportunity. But Julia, I think we have some time here too. So I want to hear what your hot take is.
Honestly, I think it's something that we've touched on a few times, but I was thinking about the thread that's running through a lot of the technologies and startups that I see on the rise. And it kind of occurred to me that I don't think consumers have had this level of power and influence in climate tech since like somebody had to step up and buy the Roadster. I mean, that was something that was like really driven by somebody being like, that is a cool car. I'm going to buy it. And that's what like gave Tesla their start. When you look at stuff like base, that's people being sick of their power going out. You've got super cheap solar now starting to boom in places like South Africa because people are like, I'm going to buy that and put it on my rooftop. And yeah, it's still not accessible to the poorest people, but this is now definitely a middle class thing and a thing that a lot of businesses can do. And then you see things like adaptation. That's about people wanting to guard their homes from extreme weather. And then on the other side, in terms of like, we've just gone through this big exercise of looking at canceled or delayed projects. So much of it is individual communities that don't want a data center because they're not seeing the jobs or the economic benefit, or a few years ago didn't want a CCS pipeline. I think like corporates are really worried about how do we deal with communities. And you can see that in like Microsoft coming out and saying, we're going to pay our way for data centers. Don't worry, everyone. So I think we've gone from a place where everything is around like corporate offtake and net zero targets and the Paris Agreement to the place where whether a lot of these climate tech industries succeed is kind of down to individual consumer um, decisions. And that's hard to control. It's hard to predict, but maybe it's more insulated from big
hmm.
decisions in politics.
Hmm. How does that tie in to the green premium elephant in the room question, right?
Mm,
Like if Roadster is
Yeah.
explicitly green premium, now if you're buying a home battery, you're hardly doing that to show off, right? Like what's driving that? You're doing that for it, resilience, I suppose, but that's like with some underlying like sensitivity to cost savings or avoiding long tail risk. What do you think on that?
Yeah, for me, it's all about the co-benefits now.
Got it.
Um, like when we were talking about our what's in and what's out, like is
Yeah.
emissions in or out? It's the side thing now. But people are willing to pay for certainty and resiliency.
Yeah. Yep.
I
Super
also feel
interesting.
like, I mean, 25, 26. It's all also about affordability, and everyone and their mom and their grandma is waking up to the fact that electricity rates are increasing, especially in the US. And it's going to become a big, political point. Obviously, it already is. And I also think people almost want to take back their own power, quite literally and metaphorically, right? And
Populism
so
for climate tech.
exactly, exactly, and I think there's this element of, it's not about climate, it's about ownership and control to a certain extent, like being able to control your own power, control your own destiny. I have a lot of friends in Texas who want to just go off grid because there's this sentiment of like, we don't want, hyperscalers, data centers driving our rates up. We want to own our own destiny, own our own power. And so yeah, I agree with that. I think that's kind of a non-climate way of thinking about how these technologies will almost swing back the pendulum from centralized to decentralized. And the Resi solar days might see a comeback.
Back again.
I love
Cool.
it.
Should we move on to in and out?
I want to hit the in and outs. Yeah, can we flash that up? This is going to be like absolute fire round because we've got some great questions coming in the Q&A. This is a chance for you guys while you're looking at us sweat here. Drop your questions. We're going to hit that in like 2 minutes. Okie dokie. In and out. This is like thumbs up, thumbs down.
Yeah,
Should we
let's do
signal
that.
it
Let's
that
do
way?
that.
All
Yeah,
right,
yeah.
cool. We've
All
got
right.
7 questions here. Let's go. Okay. And it's the end of 2026. Was data center flexibility in or out? Are we still talking about it? I think certain. I mean, fuck yeah.
Mark's hedging. What if it was just storage, not workloads?
Yeah, yeah.
All right, hit the next one. Let's go. DERs and VPPs.
Yeah.
Uh,
Oh.
all
Oh.
right,
Oh,
all
much
right.
We're
hedging.
canceling the this. It's this
Okay,
and
fine.
this.
All right, fine.
Okay, let's keep going. Oh, dang it.
I'm sad. I'm
So
sad.
sad. Someone needs a
It's
screenshot of
bad.
that.
It's
Admissions
bad,
will go
guys.
up. Yeah.
I think China's the
Oh no.
hero, which is ludicrous.
I know we're going to
Stay
be doing a
tuned
lot
for
more in
our report.
China this year. Yeah. Okay. Same wavelength. Ooh. Okay.
Mm,
Ooh,
Oh,
50
the room is
50.
split. The room is split.
We got to have
Next,
another webinar to
adaptation.
talk about this. Oh, okay.
Powerability for sure. Yeah. Last one. TRL less than
What does this
5. I
mean?
mean, does that just mean
Oh,
like
early
risky
stage.
Like
early
Early
stage
super
stage.
stuff?
early stage stuff.
Yeah. Oh
Yeah.
my God, so lame.
Oh,
That
no.
one
Okay.
also sucks.
This is not what we
Yikes.
Very
want.
sad.
This is what we think will happen. Just a
yeah.
caveat.
Being realistic.
Yeah.
Okay, we've got 3 minutes to hit your questions. Keep them coming. We've been tracking as they come in, and not to pick favorites. We're going to chat about a couple of these. Real quick, it came in early, so we'll favorite this one. What do we think is the role of CVCs, right, in this strange, funky 2026 market? One of you want to take that?
I can give a quick answer. I think it's to make the offering easier for procurement, right? So I think the idea for CVCs is to round out their offering this year of what a corporate can supply, whether that be power quality or extra transmission or grid tech, to round out a power offering, and then use that to make it really simple for people to connect their projects and get things going.
Nice.
And that can apply across different sectors as well. Yeah.
Yep. I really liked the question from Tristan about spooky. So not to take too much of a what could go wrong approach, but like say that 2026 was trash, right? Like what's the pre-mortem on investors being spooked in climate in 2026? Is that continued
Ooh.
bankruptcies? Is that there's just something super interesting happening in another space? Like, is that no liquidity coming back? I mean, like, I'm pretty bullish net on the venture ecosystem. I think we're going to have now is the time to go buy a house because in like 6 months, there's going to be a whole lot more tech billionaires out there because I think liquidity is coming into the ecosystem and is being injected super soon. It's not from climate, right? So maybe that's like a bit of a magnetism outside of climate. Maybe that spooks folks, or maybe that just drives the flywheel with liquidity coming back in.
I think the risk that's going to spook investors is not being able to raise a fund from what I've been hearing. I think it's, there's just a lot of, candidly, there's just a lot of like, how do we position this space? How do we position climate against energy, against AI, against industrialization, right? So I think there's a there for how the storytelling can happen, but
Mm.
you saw the Europe versus US fund chart. It's just hard to do that in the US if your positioning is just around climate. So I think that'll spook some investors because it'll be hard for them to fundraise, perhaps.
To get a little bit more specific, there's clearly some hero sectors and there's clearly some hero companies. I
Yeah.
think
Mm.
if there was some kind of like disastrous problem with the tech from a big champion, like, you know, Fervo, X Energy, these, or like China obviously winning the nuclear battle and it being clear
Mm,
that like American companies weren't going to have a role, or data centers capacity dropping off because a bunch of big hyperscalers cancel a bunch of leases. There's some big pivot points in big sectors that could make the numbers look very different next year.
yeah. I think the AI part, if that were to really drop off, it would be a big jolt, not just for climate, but for everything.
Totally. Okay, I firmly agree with that. That's like my big one, right? Which is stability of AI energy demand. If that falls off, no idea, guys, like where else the
Mm.
demand for all of this comes from. But we're not the only ones. We're not the only ones talking about that. Okay. And then someone kindly dropped into the chat the positive and on that, right? Which is take the flip side of that coin. If folks wake up and there's a big upsurgence in interest, what drove that, right? So what's the positive, what the positive side of that coin?
Two for me, maybe three. One is that I think last year we were talking about uncertainty, right? People are waiting for the rules to get in place. I think that even though the rules aren't necessarily what they want, they are in place. Two is I think China could drive a lot of new growth and demand in a lot of these places. Three, I think I will watch the EU ETS, review, and certainty on higher carbon prices in Europe could drive an upside scenario for climate tech, as it were.
All right. Okay. We're going to round it out because we have a couple minutes left. We saw a question in there on, will you guys ever do a podcast? We might. We might. We just very well might. So
Stay
keep a
consolidated,
lookout.
Kim. Yeah.
Yeah. All right. Okay. To wrap things up, thank you so much for all joining. Before we all say goodbye here, a lot of what you saw today, a lot of the charts, a lot of the data, everything you're seeing in the report is all coming from Sightline. So Sightline isn't just the four of us. It's not just the newsletter. It's a whole product, a whole platform, a whole company. And we work really closely with a lot of corporates, such as the ones on this page, investors, banks, governments, and we provide data around not just companies and investment, but we're really looking at projects. We're looking at cost and performance benchmarks. We're developing a lot of research. Big shout out to Julia and the research team on how these sectors, how these markets are evolving over time, who's doing what across the market, and really what our take is in terms of how things like data centers, power demand, clean from power, grid tech, low carbon fuels, carbon will really start to shape up over the next few years. And of course, we'd be remiss not to mention AI. We've built a lot of AI tools and features within the product as well, so that it's easier to keep up to date with all the data and research that we're putting out. And beyond just these public webinars, we host a lot of events, a lot of webinars, a lot of briefings within our client ecosystem as well. So if you're interested, feel free to download the Investment Trends Report, learn more about Sightline on our website. And if you want to talk to us, talk to our experts, request a demo, and we'll set up some time to walk you through the product. So thank you all for joining. Fantastic questions. We'll follow up with the recording as well, so you'll have it. But hope you all have a fantastic Thursday, fantastic weekend, and we'll see you in your inbox tomorrow. Thanks, everyone.
Bye.
Thanks
Bye.
all. Bye.
Bye.